Hello, welcome to the mechanics of money. My name is Darren Bush, and all my commentary is not professional advice, but merely my opinion. I do perform extensive research, though. What you see here is what I call the executive summary report. What you see is bank. Uh, what you get a good picture of how the economy is running right now. Bank failures, you get the month to month comparison. So you see April, the failures, the bank failures were at a certain level, and now the bank failures are a little bit higher. Also, the hedge funds credit default swaps are increasing. Home prices are actually going down. Auto loan defaults are going up. Credit card defaults are going up as well. Commercial property defaults are also going up as well. Um, the unemployment rate has dropped a little bit. The savings rate has gone down. The amount of savings that people have month to month has gone down. The real wages growth um, has actually also gone down as well. That percentage has increased, meaning that the real wages, has gone down. Um, there's been a big drawdown on the Magnificent Seven as it relates to Nvidia, um, Apple, those big cap stocks. Those particular stocks are gone down significantly. Also, market breadth, which measures the amount of selling that's going on in the market, has increased substantially. And also, the prices of homes on the Red Book Index is also the prices, the decrease of homes have actually gone up too. So now we have the money supply, the M1 and M2 money supply, which is decreasing, which is the key indicator that the liquidity in the market is going down right now. We also have personal savings. Personal savings is decreasing right now as it relates to May. It's going down. We have the PMI report, which shows shipments and some services, industrial services. You see manufacturing. You also see your services are actually about the same, but manufacturing is going down a little bit. We also see the SOFR rate, which is the borrow rate that hedge funds and banks get when they borrow money, and that rate is actually increasing slightly. What we have is the next chart we have is the default rate as it relates to credit. You have the audit loans. Auto loans are actually going up. The defaults on auto loans, the defaults of credit cards are also going up. The defaults on mortgages, and also the defaults on commercial properties, which is also interesting as we go to the month to month comparison. Now let's take a look at the Magnificent Seven. We have a drawdown on all the Magnificent Seven stocks, right? We have Meta, Tesla, Microsoft, Amazon, Google, Apple, and Nvidia. You see, all these stocks are on the decline right now, which gives you an idea of what direction the market is going in. So now we have the 2 year versus the 10-year Treasury yield, and what we have here is quite interesting. What you have is what they call the yield curve inversion, right? So what that means is the 10-year yield is higher than the 2 year yield, and this happened in October 2022, and it also just happened recently. So usually when we have this yield curve inversion, it means that we're heading towards a recession. It's a key indicator that economists use, and it's an indicator that we're heading towards a recession. Now we have the Buffett indicator, which is interesting too, where we show that the Buffett indicator shows what the valuations of stock, right? It lets you know whether stocks are overvalued or are they are valued fairly or they're undervalued. But in this case, what you see on this line graph is that it's been steadily increasing, which makes sense with the S&P 500 going so high. But one would have to ask, how high can the S&P 500 can go, understanding that the stocks are overvalued. At some point, there has to be a correction in the market. So next we have the nominal GDP and the 10-year Treasury yield. So as you see the increase in the 10-year Treasury yield, there is a symbiotic relationship between the nominal GDP and the 10-year Treasury yield. So as the 10-year Treasury yield goes up, the nominal GDP goes up as well. And this particular chart is quite telling, right? I want you to pay attention to this particular chart. This is called the internal market breadth, right? So what we've seen, this has only happened 3 times in the history of the stock market, right? Where the internal market breadth has gone down to 37%. Has gone down 37%. And usually, this is 100% accurate. So every time this internal market breadth hits 30 goes down by 37%, then it triggers a recession and a market correction. So here we have was what they call the Hindenburg-Omen indicator. This indicator has been triggered twice. It was triggered once in May of 2023, May 23rd of 2024, and also June 13th of 2024 as well. And this indicator definitely lets you know that we're heading towards a recession. When the Hindenburg Omen triggers, it's usually a recession after that. And that's why I'm bringing these charts up, to let you know the direction that the economy is actually going in. The next we have the Titanic indicator. And this is a similar indicator. It lets you know is when this indicator triggers, it lets you know that also that there is a very good chance that we're heading towards a recession. These indicators are very accurate. So now we have the executive summary report, which just shows you that hedge funds, the credit default spread are going wider. Okay, the VIX is inverted. There's a downward pull, which we saw in the charts with the Magnificent Seven. Real wages are going down. CEO confidence is stable but worrisome, and the retail sector is softening, and the Red Book index is dropping from negative 108 to 1.4%. Now we'll talk about the liquidity and credit risk overview. The reverse repo balance is going down considerably, which is interesting. It's very telling in the market because the economy just received an infusion of $2 trillion. $2 trillion in the reverse repo. This is used by hedge funds and banks as loans to create liquidity for their companies. And as you can see, that they just gave them $2 trillion a month ago, and now it's down. It's pretty low right now. I think it's down to about 130 billion right now. So that's a significant drop, and it just shows you that liquidity is drying up, and they really need some type of liquidity to pay on their outstanding debts. Also, we have the OS spread, which is the Lumbar, the LIBOR, or the SOFR report, which signals a credit risk in the banking system, and that's flattening now. So it seems like everything's starting to slow down, and it's going into a different direction as we start creeping towards a recession. Now we have the Citadel's credit default swaps. They're also increasing. Brazil's short exposure is actually going up as well because they just had a big scandal in Brazil. It was kind of $1 billion Ponzi scheme that was just uncovered by the authorities in Brazil. So this has kind of shaken the economy down in Brazil, and a lot of banks are being exposed in this Ponzi scheme. Also, redemptions as it relates to hedge funds have gone up significantly. Now, if you don't know what redemptions are used by hedge funds as kind of like a stopgap approach to stop people from similar to like a run on the bank, right? The banks don't, when there's worry in the market, banks don't let you take, what happens when there's a run on the bank? The bank actually shuts down all the ATM machines, right? Or they lock the doors and don't allow you to get access to your money because there's actually run on the bank. So this is similar to what hedge funds do. That's why they call it redemptions, right? You sign a contract with some of these hedge funds, and what happens is that in that contract, and some don't realize they're signing this contract, but in that contract it states that, hey, you can't take out your money immediately. What you have to do, you can only take out a certain percentage of your money each quarter, right? And that's a stopgap approach to stop people from making a run on the hedge funds and ultimately everybody taking the money suddenly out of the hedge funds and exposing them to immediate collapse. Next, we have UBS and Credit Suisse, which is very interesting because Credit Suisse was bought out by UBS. And UBS received about a $6 billion guaranteed loan to buy Credit Suisse. But the problem is that Credit Suisse had a lot of toxic assets that came over from Archegos, right? So when UBS bought Credit Suisse, there was a concern of the Swiss government because actually UBS's balance sheet is $1 trillion, which is 132% of Switzerland's GDP. So in layman's terms is that which is really significant here. In layman's terms that means if UBS collapses, that means the whole Switzerland government could collapse. So the Switzerland government went to the UBS, said to UBS that we're concerned about your financial positioning with Credit Suisse having all these toxic assets. So we want you to pony up more money with capital. And UBS actually, they balked a little bit and they were thinking about actually moving their headquarters somewhere else, but I think they acquiesced and ended up increasing their capital. Also, we have an increase of shadow lending that's happening overseas and also in China as well. Next, we have this is the actual statistics as relates to auto loan defaults. There's an increase in the less than 30-day auto defaults by 3.5%. 90 days and out, there's an increase by 4.8%. Credit card defaults increased with under 30 days by 3.5%, and 90 days plus increased by 12.3%. Also, commercial defaults also increased from 5.6% to 6.1%. So we're getting a pretty good idea of what direction the economy is going in. So next we have unemployment, which is increasing. The savings rate is decreasing. The real wages growth is decreasing as well. Then we have the VIX structure, which is inverting. We have the Bank Term Funding Loan Program. This particular program loans money to banks that are having some difficulties meeting their obligations, and that's increasing as well. And that shows you the liquidity in the market as this statistic goes up with the Bank Term Funding Program. And the credit default swaps are also is at its highest level in 7 months. Next, we have the internal market breadth, which is again is 37%. The Magnificent Seven, Nvidia is down by 20%. The margin call modeling is spiking liquidity. So that means that we're getting a lot of margin calls as relates to hedge funds and banks. Next, we have a rise in layoffs, freight and rail. We have weak volume. The CapEx, which is a fund that deals with the property, buildings, and technology and equipment. That's under pressure right now. Used car prices are falling. Office vacancies are increasing by 19% nationally. The BRICS, which is interesting. This is an interesting story. The China and Japan are now dumping treasuries. They're dumping U.S. treasuries. So that's having a direct, that's devaluating the U.S. dollar. So now the BRICS is outperforming the U.S. dollar right now. So I guess the question is this, a lot of people are asking, is this the end of the U.S. dollar? Is the BRICS actually going to replace the U.S. dollar? And a lot of people are asking that question and wondering if that's going to happen. Next, you have the continuing you have the M1, M2 supply. We have a continuing signal of monetary tightening. Liquidity is actually drying up. We also have retail reality check. Foot traffic is actually kind of flat in the retail stores. The rebooked index is actually down. And again, the CEO confidence is stable but cautious. There might be some new investments the CEOs are thinking about going into, but because they want to kind of play a wait and see approach to see which direction the economy is going in, they're going to kind of sit down and wait and see how everything rolls out. So now we have the Dow transports in industrials renewed divergence, and we already talked about the Hindenburg and how it was triggered twice already. Inside sales, we have the top heavy distress clock, where insider sales are at a 3-month high and earning revisions are at a negative momentum. So here's the assessment. Here's my assessment. There is a rising risk of recession. There's structural fractures that are forming in the market right now, and this is indicated by the internal market breadth report. The Fed's instituting quantitative tightening, but I think they did this too late. I think the Fed move to do quantitative tightening. They should have. It's my opinion that the Fed should have done quantitative easing. They should have moved away from quantitative easing a long time ago. And I think this is what Volcker was trying to tell Powell early. I think a couple of years ago. He was talking to Powell, and I think Volcker was telling Powell that, hey, you need to think about what's going to happen with the economy if you don't go away from quantitative easing and let the correction happen. Then the economy might get out of control. So all these indicators point towards a major correction similar to the GFC, the Great Financial Crisis. There's a lot of money sitting on the sidelines as it relates to Warren Buffett. Warren Buffett just sold a lot of his large cap stocks, and he's currently sitting on $346 billion. So one would have to wonder why the Oracle of Omaha is sitting on so much money currently. What is it? One has to ask themselves, what is it that Warren Buffett knows about the economy that we don't? And obviously, he knows that these large cap stocks are going to make a correction. So he's taking his money out so he doesn't take a loss, obviously. Warren Buffett is probably one of the smartest people on the planet, right? So obviously he knows something. He's reading the tea leaves. So he's sitting on the cash right now and waiting to see what direction the economy is going. But obviously it looks pretty obvious that we're, by all the indicators, that we're heading towards a recession. So even Michael Burry even chimed in and said that we're heading towards a recession similar to the Great Financial Crisis. So everybody's kind of positioning themselves to prepare for this. So if you like my podcast, feel free to go to my blog at the Legends of the Ledger of Life at https www.taxman.today. Again, that's taxman.today. And thank you for watching my channel. You have a nice day.